Hello and welcome to Livewire's Fund in Focus. I'm Ali Selby and today we're joined by Kelly Marty from Churchill Asset Management by Nuveen to learn about the firm's private capital markets strategy. Thanks so much for joining us today, Kelly.
Thanks for having me, Ali. It's a pleasure to be here.
Just to start off, for those that don't know Churchill, what sets you apart from the rest of the pack?
Yeah, sure, absolutely. So Churchill is a $50 billion asset manager, and we're focused on what we term the core or traditional middle market here in the U.S. And we're focused on sponsor-backed businesses, so we're helping sponsors finance leverage buyouts. And we're providing debt across all aspects of the capital structure. We're providing both senior secured floating rate debt, junior capital investments, second lien debt, and or equity co-investments, depending on what the sponsor's preference is for our participation.
Can we go through your tactical allocation strategy?
So the fund is unique in the sense that the fund is anchored in senior secured floating rate investments, but there's also a portion of the portfolio allocated to junior capital, and that can include both second lien floating rate debt as well as fixed rate junior capital. And we have a small allocation in the portfolio to equity co-investments, which can provide some nice upside potential for our investors as well.
We've seen a flood of new entrants in private markets in recent years. Does Churchill have an advantage when it comes to accessing deals?
So when it comes down to accessing deal flow in sponsored-backed transactions, the most important thing is to have strong relationships with those private equity sponsors. And Churchill is unique in the fact that we have about $12 billion invested directly in over 300 private equity funds. By providing these investments in their funds, we become a limited partner, and that provides consistent and robust deal flow for us from those private equity firms themselves. So that's a distinct competitive advantage in this space when having those deep-seated relationships with sponsors is the main thing that's going to drive that deal flow.
We've seen deal flow slow down in recent years. M&A has really been on ice. With interest rate expectations heading southwards from here, will we see a reversal in that deal flow activity?
We definitely expect that we will. And so as you mentioned, the last couple of years M&A activity has been down, and the real reason for that is just a delta between the valuation expectation of a selling sponsor and a buying sponsor. And the reason they haven't been able to agree on the ultimate valuation of a business is due to that high cost of capital, given where interest rates have been. So with interest rates coming down, we're seeing that delta between the bid-ask of these businesses start to shrink, and as a result, we're seeing an uptick in M&A activity, which is a very positive change for the market.
Okay, with that outlook in mind, what makes a good private credit deal? And on the other side of that, what would make you turn down a deal?
Sure. So there are certain credit attributes that we look for in the transactions that we choose to finance. Our selectivity is about 5% of the deals that we actually see we end up closing. So we're very selective as far as what ultimately we approve and close. And there are certain attributes that we want to see deal in and deal out. Number one would be market share. We want to back borrowers that have a strong market share, a reason to exist, and as a result have pricing power in their particular market. We also want to see a borrower with a strong track record, strong financial performance, and also strong projected financial performance. We don't want to see any headwinds coming as far as their demand patterns. Another trait we like to see are companies that don't have a lot of subject to cyclicality. So if companies have a more non-cyclical or acyclical demand pattern, we view that as being very attractive. We also like to align with strong management teams. That's an important part of our due diligence process as well. And finally, the equity sponsor. It's important to align with private equity sponsors that we know, that we trust, and that we have a track record with.
What does a bad deal look like though?
Sure. So there are a few red flags that we see that will quickly cause us to turn down a deal. One of those would be customer concentration. So if you're looking at a company that has an outsized concentration to one particular customer, you're going to be vulnerable if that customer somehow declines their demand patterns or goes away. So that would be definitely a red flag. Another thing I would say is I mentioned cyclicality. So if you have a business that's very prone to cyclical demand patterns, that's a hard company to underwrite because it's very difficult to forecast what the macroeconomic landscape will be and what those demand patterns will look like. Another red flag I would mention is the regulatory environment, and this comes into play sometimes in the healthcare space as we look at potential regulatory changes down the road, or what we call stroke of pen risk. that a regulation could be passed that could impact a business. And if we have any sense of that looming, even in the next 3 to 5 years, that would be another red flag that would cause us to decline a deal.
What are some of the risks investors should be aware of when investing in private credit?
Well, the biggest thing to assess as you're investing in private credit is who's the asset manager that you're investing with. All of the asset managers have a distinct way of approaching credit. They have a specific risk profile that they're seeking. They have a specific sourcing capability, i.e. who they're getting their deals from. Again, ours are coming directly from private equity sponsors themselves. Another thing you should assess when you're looking at asset managers are what are their workout capabilities. We spend a lot of time doing due diligence on these businesses, making sure we're making the right investment selection criteria for our investors, but there is a chance that a deal could have some financial softness. So knowing that the asset manager has the staff and the ability to work out these transactions is another important attribute to look at as you're assessing asset managers. And where do they play in the market? Are they in the lower middle market, the traditional middle market, the upper middle market? All three markets have slightly different attributes to the deal flow and to the ultimate structures, so it's important to know where that asset manager is aligned.
Are there any key elements of the strategy that you think investors should be aware of?
Sure. So the strategy we view as a unique opportunity for wholesale investors to have access to private capital. And the fund's portfolio allocation is unique in the sense that the lion's share of the portfolio will be in senior secured floating rate debt, but it also has a tactical allocation to fixed rate junior capital as well as equity co-investments, which can provide nice upside potential for our investors.
Okay, last question for today. How can investors access the opportunity?
Sure. So the strategy is now available to Australian wholesale investors through a fully registered product disclosure statement that will be hedged to Australian dollars. Wholesale investors will be able to access the strategy through monthly applications, and the strategy will be available on all major platforms.